It's like 3:44. I'm doing a recap, just to update or whatever. Um, About to put a little bit more in here, but this is where I'm at now. It's kind of late, so I'm trying to talk a little low, so I don't wake everybody up. Um, this is where it's at. This is where it's at. It's where it's all at. Slow and easy. Strong representations. Strong companies. I had a chance to watch some of these companies do their thing in the last bull run, and some of the numbers that I was taking notes from, let's say, I don't know, 2 years ago, maybe 3 years, 2 years ago, they were still doing a little running upwards. So kind of volatile when I came in, but I still had a little run upwards, and then it started after the 2019 pandemic, things started going down. But I did have a small chance to watch them move, and how fast they can move. So I know some of these personally. I know their potential. Need to get this one up, but I've been waiting for this one to drop a little bit more. I expect another 20 to maybe 40% drop, but then um, I don't know, these institutional people, the big sharks and stuff, they're kind of smooth about how they move. The market will turn, and they won't, you won't be getting that information. You'll be getting the information that the market is dropping, causing you to sell, while the big guys are buying up, at the low prices and stuff. And then by the time they start spending their billions and millions, they done, you know, shot the rate up for the retail investor. Um, yeah, it's one on here that shot up 20% in one damn day yesterday, and I can't think of it on top of my head, but I'll find it real quick and show you. I guess not, maybe not. As you can see, I got them spread real wide. Yeah, I can't find it. I forgot. It was right at the tip of my tongue. And I'll find it. Give me a second. Alright, so yeah. Oh, now Stash allows you to buy Bitcoin and stuff, as you can see. Bitcoin, Avalanche, Ethereum, Uniswap, Chainlink, Solana. Those are the ones I bought. I think they have like Bitcoin Cash and then Ethereum Classic. So those are the only two that I didn't buy, which are the two that I should have bought instead of Ethereum and Bitcoin Cash because of their utilities or whatever. Bitcoin Cash is like I don't know, speedier version of Bitcoin, which is Bitcoin's biggest problem, speed, and it's at a much lower rate exponentially. I mean, which can cause you to get a better exponential growth. The lower the number, obviously, the better exponential the growth opportunity. The way I see it, maybe it's just a poor man's mindset. But I do know it's a lot easier getting to, let's say, $100 to $1,000 than it is getting from $1 million to $1 billion. I do know that much. So with that in mind, um, I invest a lot in penny stocks and low cap stocks as well. And obviously, my objective is to catch these large caps and mega cap stocks at the lowest possible strike points. And as far as Bitcoin and all, I have other crypto and other sites, other exchanges. So this is the first time I ever bought it on this exchange. But it's good to have all your assets spread out over a few exchanges, so that way, if you ever had any problem with exchanges running slow because people trying to rapid trade, or if you ever had a problem with maybe the electricity went down and maybe one exchange doesn't back your money, the other exchange does back your money. Like Fidelity, it's FDIC insured, so they back your money. So whatever I'm investing in crypto or stocks or whatever, it will be also backed because it's a bank. It's FDIC approved bank. Whereas Stash is not. Stash doesn't back your money, and then the crypto is ran by Apex Crypto, as you can see down at the bottom. So you got to be careful with that. Know which banks are backing your money in case there was ever an issue where a issue with your money. You can have some type of control. But yeah, I'm gonna fly through them real quick again, and I'm going to go ahead and position all this a different way. That way you can see it all again. And I'm not doing bad, to be honest with you, with as bad as this market is doing. I'm not doing bad at all. I have, like, I believe 70 different assets, and to have such a wide array of assets for such little amount is kind of amazing. Warren Buffett, I think he has like, I don't know, I think he has a portfolio with about 70 assets, and I think his personal portfolio has about 70 assets in it. And you can best believe he's pushing a lot more than I'm pushing, of course. But yeah, I started out 70 to start my spread wide. And then as I go on and learn, I can take, the ones that I'm most certain about and try to position them at the top with putting them, building high or stacking high with them while leaving the others a little bit more stagnant. So focusing my money on the ones that I really have the most confidence in. And then, you know, towards the end of the 10 years, I'm not focusing my money on, you know, the ones that doesn't have that potential as much. I'm more focused on the ones that does have the long-term potential, and then my growth stocks, the ones that may flare and then dive back down. Those type of stocks, I put them last, lower, so that I don't, chance my portfolio as much. To get more stability on my portfolio. And if you notice, I got a lot of ETFs and stuff like that, and a lot of strong mega cap stocks to support my overall portfolio. That way, if in case, some of the more innovative stocks that I'm investing in, if they don't go like I expect, or if they crash, then I'm supported by more secure stocks like, your mega company stocks. So, and that's about it. So, I'm going to go through here again real fast. And I'll position it another way before I stop the recording. That way you can see it positioned multiple ways. I'll try to remember to go back and show you my exact percentage of loss so far, which is not bad at all, I think. I think it's around 15%, maybe 20%, which is really not bad for all these, assets in my portfolio. Some of these stocks, I end up getting some of the really low amount, like 10 cents and stuff like that. A lot of those come from me striking a stock just to put it on my watch list or to pay attention to it, be more closer. And the other ones, some of the, penny fees, I mean, penny balances that you see on them, that comes from stocks that I get from stock back purchases and stuff when I go to places like Dollar Store, Family Dollar, Amazon, Walmart. Whenever I do shopping, I have it set up so I get stock backs to hit my stock account. That way none of my money goes in vain. And what I try to do is I try to use my credit cards when I'm making, non-street transactions, like, when I'm walking into stores or eating on a daily basis and stuff like that. I try to always use the credit card first. That way, I can get stock backs and stuff like that, kickbacks. And I also set it up at the gas stations where I get the kickbacks at the gas station as well. That way, when I go in and use my credit card, I make sure I use a debit on the credit card, because what most people don't know is that when you get gas, there's always a separate fee for credit and debit, and they smashing us with this. It's amazing. Like, these guys are able to buy new yachts every year or every quarter if they want, just off that differential in price between cash and credit card payments, and nobody know about it. So it's good that I was able to bring that up. I had the opportunity to bring that up. So the way I set it up is I go in there and I set up the cash back with them to use the credit card, or whenever I use my credit card at the, let's say, Shell gas station. And then I also have it stock back, so that when I use my stash card at that Shell gas station, I get a kickback on that as well. So the gas station ends up giving me a kickback on my stock, and then the actual credit card of it being stashed and me spending that money, that gives me a kickback. And then on top of it, I make sure I use a debit transaction instead of a credit transaction, because these guys are smart. That 5% that one and then 5% that the other's giving you back, they'll get that 10% back by charging you 10% or damn near 10% more, which is astronomical when you think about it, on your gas, simply because you didn't put your PIN number in there and you just swiped your card. And if you ever hand your credit card to the gas guy or gas cashier, you'll notice they'll always run you for credit instead of running you or giving you an opportunity to run for debit. And the reason why is because if you pay attention, you'll see that they charge you. For example, if the gas is, let's say, $3.25 for a gallon, which is what they're advertising, you'll notice when you go outside and pump after paying credit, it'll be $3.55 or some shit. Like, they literally charge you 20 cents more per gallon or something. So you really gotta pay attention to that. Always use your debit card whenever you're getting gas at a gas station, and always set it up so that you get the kickback if the gas station's offering that, and then set it up also so that you get the kickback off of whatever card you're using, which is hopefully some type of one of your exchange cards like Stash, Fidelity, Webull, whoever you're using, crypto, .com, Coinbase, whatever card you're using. So here we go. I don't really like stocks like McDonald's at all, even though they perform well. But I don't like, certain stocks if they're not performing a certain percentage per year. So I try to find that stability in a stock, but also find that good growth in a stock, even though it's a really strong, stock. McDonald's is a super strong stock, for example, but it has, I think, about a 30% average growth per year, maybe 20% average growth per year. So, 10 years could only equate to about 200%. So if I put my money into something for 10 years, I don't want to just have it double twice. So I'm looking for more of a return. So something like that, I only got $5 in so far, as you can see, but it has grown 6% in a rough time. This is all bad time. It's a good time to buy, but bad time to expect growth.